Kitco Mining special coverage of the Mines and Money Miami is brought to you by Snowline Gold.
We still haven't felt the full force of Fed tightening, warns Mike McGlone. He is macro strategist at Bloomberg. Mike, welcome to Kitco.
Thanks for having me back. I've been involved in working with Kitco for years now.
We appreciate it. We appreciate the content, Mike. Let's talk about, you've, in another interview, you said, don't fight the Fed. What does that mean for markets?
Well, I'm afraid the fact that I have to say that a year after we first started saying that, is part of the problem in markets. And that is the Fed is still tightening as the market in the world tilts towards recession. Now, some people think it's not. I like to say, well, it's called long and variable lags. And the fact that we're on February 23rd and a year ago, the Fed funds rate was 0. Russia had not invaded Ukraine yet. And most commodities are lower and Fed interest rates are still going higher is a very bad sign, particularly for industrial metals, which is probably the focus here. It's a good sign for gold eventually, but to me, that's the macro. And I fully expect that tide, that ebbing tide of the stock market and commodities to continue to revert lower. So that's the trajectory. And I like to ask myself is what stops this? Typically is substantial easing or a lower plateau in prices. And both were far from those levels.
Thanks for setting the stage and where we are right now on late February. I want to get into commodities and what your view of the commodities are. But before we get there, just talk a little bit more about the Fed, because we've seen a lot of news that has come out, whether it's going to be the jobs report, whether it's going to be the inflation report right now, which really seems that they still kind of have to tighten right now. Correct, Mike?
They do. It's an unfortunate, but it's the unique stage of the cycle. There's nothing they can do but tighten, although they should be easing soon, but they have to because they got stuck in that transitory stage of inflation. Inflation is going to improve to be extremely transitory in my view, very deflationary. A year from now, when you and I are talking, Michael, I think we're going to talk about how much is the Fed going to ease to alleviate this recession. So first, let's look at the yield curve. You look at a global yield curve or the U.S. yield curve, it's the steepest it has been in many years, maybe 40 years. And the probability of recession from the yield curve is very high. So probably going to get that. But the key thing about the Fed tightening is they are tightening now with commodity prices collapsing. If you look at the Bloomberg commodity index, you look at natural gas has dropped to lowest price since 1990. Lumber has collapsed. The darlings of the rally have collapsed. Crude oil has almost collapsed. It's back to 75, which is the average price, the price first traded in 2006. Copper's come off its highs. And my point is they're still tightening. Most central banks are still tightening, except for two. We have China still easing, and China's an export-dependent country. And the rest of the world, most significant import demand pull country in the world is tightening the U.S. And Japan is still kind of doing quantitative easing. But these are, the top 3 countries in the world. And I think they're just doing the best they can to keep up with what's a major pump then dump. So this is the thing I like to point out right now. We're in the midst of, I think, the greatest macroeconomic reset of our lifetime. So we had the biggest pump in liquidity in history for good reason. It was only 2 years ago we got vaccines. And now we're in the midst of the biggest dump. You look at things like U.S. money supply. It's never been up as high as it was. It's never been down as high as it is now. It's a negative year-over-year measure. We look at things like PPI and CPI, and the latest numbers are a little bit high, but they're dropping so fast. So here's one thing I'll leave you with I like to point out. The latest PPI measure came out high, but so did retail sales. But if you take retail sales minus PPI and CPI, it's negative, and it's only happened twice in our data, and every time we've had a recession. But the key thing about PPI is I'll make this projection on July 13th. June PPI is going to print, and I think it's going to be negative year over year. The historic extreme for that was minus 6.9% in July 2009. You remember that well, probably. It was the back end of recession. But that's what happens with producer price indexes, which is very closely related to commodities, is it peaked last June and it's heading lower. And you look at things like natural gas and unleaded gas demand in the States are all tilting lower. Housing permits, new homes under construction, all just turning over. And the key fact is, on a 1 to 10 scale, the only thing that matters is the Fed is still tightening. So my point is the lagging nature of unemployment and the leading nature of markets are going to all head lower. And here's the key. I'm supposed to leave you with one thing. The final thing I want to leave you is the recessions always start when unemployment bottoms from very low levels. And that's the stated goal of the Fed, is to increase unemployment to reduce inflation.
Let's go through the commodities, Mike. Let's start with gold. We had that great start to the year. We are up into the 1900s right now. It seems like it's been kind of softening as the weeks have gone past. What's happening with the precious metal?
Maximum pain before the gain. I fully expect gold in US dollar terms is going to break above $2,000 an ounce and never look back. It's made new highs in the yen and the euro, and typically it's a matter of time in the dollar. It's waiting for one key thing, that pivot. So the key thing I watch for gold is I watch the Fed funds futures in a year. Once we see that the market said, okay, we're not going to have higher rates next year, still priced for higher rates, what we're speaking right now, but I think gold's going to break out higher. But for that to happen, we need the continued deflationary forces to kick in. So I think what's going to happen with the gold is the stock market and copper are going to continue lower, and gold's going to break out higher. That's my base case for a year from now.
A lot of glum people right now that own gold mining stocks right now, Mike. It's been a tough market for them as well, too.
It is. It's a thing I like to point out about equities in terms of gold mining stocks. The key thing I watch is the GDX. And if you measure that over historically versus the actual physical gold or GLD, the ETF, the miners typically underperform. And I think that's because it's the elasticity of supply, and part of the reason the price of gold should continue higher. You just can't create more of it with rapidly advancing technology like you can with crude oil. So the miners can only do so much. I mean, it has to be more tactical. Picking the right ones matter. So I always like to say, if you just go to the actual metal, it's easy to store. It has outperformed GDX, or the miners, over time, and I fully expect that to continue. So that to me is part of the problem. But, you can get 100x in a good miner once in a while, or maybe 10x. You're not going to get that under gold. But it's the macro I focus on. It's that underlying metal. And I look at it as I don't see what stops it, Michael, right now. It's because the Fed's going to have to pivot. Unemployment's going to have to bottom. The U.S. is likely to head to recession. That's my base case. And I look at it as a macro sense. We've had 100-year events all lining up. We had the biggest pump of liquidity. We had that cheerleader and chief president, nothing against him, but he was pumping up markets. And then we had this war, and they're all kind of tilting the other way. The key point I like to point out is when people are bullish risk assets like copper, like industrial metals and crude oil and stocks, Fed's still tightening. But that's where gold's going to come out ahead. And I look at gold as it's an enduring bull market that's had a dip. And it's back to the dip, maybe 60-month moving average, and it's kind of inching up, and it's going to make it as painful as possible. And I look at things like crude oil. It's had an enduring bear market that's had a bounce. And it's heading lower is part of the reason gold should go higher.
You mentioned copper. Is it a risk asset? And let's just lump in all of the, the energy transition or the critical metals, lithium, go down the list, nickel.
So the macro big picture, I am bullish metals as a space, metals sector. And that's number one. Metals have outperformed almost all commodities over time. And they've outperformed most commodity-related equities, particularly metals-related equities. Why? Because metals are the cheapest, easy to perform, to storage. You can store them on your finger, and they don't have issues with contango and backwardation. You can buy ETFs and get the physical, and your costs are 1% a year. It's easy. You buy crude oil, you can't. You have to worry about contango and backwardation. But to me, that's the fact about metals. So the whole gamut is, so I recently published my outlook, my metals outlook, and I fully expect the copper downward trajectory. So at this point, we're basically a year after the invasion. Copper's down about 10%. Okay, that's kind of a bear sign. It's bounced, but bear markets are supposed to do that. Gold is about flat. And I fully expect copper to continue lower. So here's one thing that I think is significant as far as a risk asset. If you take copper, the pound price, the North American pound price, it's about $4 a pound right now. Multiply by 1,000 and overlay it with the S&P 500, it's the exact same chart. Almost the exact same. And they're both starting to roll over. Remember, what's that dangling carrot? It's the Fed's tightening. So that's what I see. I see copper more likely to go towards $3 a pound, and eventually go break out above 5. But in the big picture, I'm very bullish. In short term, we got to get through this recession, and having a soft landing when the Fed's still tightening is kind of a silly conversation. How people are having that. But so to me, that's my outlook. I fully expect the S&P 500 to head towards 3,000 in a normal recession. Copper heads towards 3 in a normal U.S. recession, and gold to break out higher. We can rope in all the other commodities, but that key one, copper, and if you look at aluminum, it's already down 20% on a 12-month basis, and the high in aluminum was put in 1988. So it's just a problem with some of this. I like to use this example for most commodities is people are smart, commodities aren't. And that pertains most notably to everything but the metals. because we just can't create too much more of them with advancing technology, and we're using more and more decarbonization, electrification, but that's going to take a little while, I think. Right now we have to get through this period, which I think is long and variable lags, and like I said, what we're speaking right now is a year ago, the Fed funds rate was 0, and now it's almost 5%. We have to expect a pretty significant lag in effects before that to really show up in the economy. It's early days.
Is the oil sector and oil prices, is that also going to be reflected? It's going to follow the same themes that you're seeing with COP?
Yeah. So I like to say, if you're bullish crude oil, you're bearish human ingenuity. And I like to point out the price of crude oil made its high in 2008 at 145 WTI. The high in the last move last year was 130. That's a lower high, trickling down around 75. I fully expect crude oil to go towards 40. That's the U.S., Canada cost of production. Largest surplus of overall, if you take liquid fuel production in U.S. and Canada minus consumption, it's running excess of around 4 million barrels a day. That's about the kind of the incremental demand. We maybe will get half of that from China if they really reopen. So that's the fact of crude oil. And I like to say, why shouldn't it follow natural gas? The number one measure of heat and electricity in U.S. and Canada is natural gas. And natural gas has dropped to its cost of production around 2. It was at 10 last year. That was one of the biggest trades. I'm an ex-trader. I'm like, okay, that's the thing about being a strategist. I know where I would have got stopped out, and I did, being bearish crude oil, and where I'd get back in, and I'm still bearish crude oil. So I think crude oil is going to follow natural gas toward its cost of production, which is around $40 a barrel. 75 is the price it's been hanging out at. 130 will be a peak that might last for a long time. And just look at supply and demand elasticity. Crude oil is bearish. And the key thing I like to end with is 10 years ago, definitely during the financial crisis, about 10 years ago, the world's largest demand pull importer of crude oil on the planet was the United States. Now a net exporter. With Canada, a massive net exporter, like I pointed out. 4 million barrels a day excess. And that's on a elasticity supply factor after that big pump last year. So demand destruction is instant when prices pump, but supply keeps coming on. So to me, that's the bearish case. People point out the hopium of China demand pull, and I just point out incremental demand from China has been declining for a long time. And then you look at things like they've been stimulating forever, and you look at the macro, they've become a very autocratic regime, and I've been pointing out for years their incremental demand, and China's been in decline. And I think that's accelerating, and particularly if they can't export, and the major import country in the world is going into recession.
I wanted to finish with China. I mean, there has been some good pictures, or should be some good news that has been coming out of China. So we should talk about COVID right now. Yeah. There is also talking about that they want to present a friendlier face to the world right now. They are going to continue to have to invest because they have to get out what was happening with COVID right now. But you say there's too many other factors that are just override on that.
Well, to me, the macro is overwhelming. Number one, we can't really say they anymore. We have to say he. Mr. Z has become China. Very autocratic leader. That's not the Ding we know from 20 years ago that took 1 billion people, that was average per capita income around 3,000 and brought it towards 20,000. Now it's really heading lower and flat and stabilized. And it's that factor of the biggest mistake that from a Chinese leader, and maybe in history, was cozying up to Mr. Putin, unlimited friendship right before the invasion. Now the whole continent of Europe is doing everything they can to get away from China. Now, Mr. Z is trying to lighten up on that, but that was a big mistake. I see it everywhere in the States. Onshoring, reshoring, getting away from China, going to Mexico, it's just getting started. Unless something shifts in the leadership there, in the sentiment, and that focusing on this war and supporting unlimited friendship, to me, that's the macro that's just getting started. So, and then I like to ask a final question. I always like to ask, do you know anyone who wants to or is immigrating to Russia or China? It's the key lessons I learned from the book, 21 Lessons of the 21st Century. If no one wants to immigrate there, you don't want to be to that country. And another lesson I learned from a great Canadian, Jeff Booth, who wrote The Price of Tomorrow, about the deflationary forces of rapidly advancing technology. So that's why I go back to China's falling way behind there. They steal intellectual property because their system doesn't allow it. They have to. And in the United States, in the Western world, that intellectual property has allowed us to have natural gas at the same price as 1990, and this massive excess of liquid fuels and fossil fuels. Now we have this major transition towards EVs. I mean, I drive an EV, and it's just a better way to get around. What is that? 20, almost 30% of sales of electric cars in China last year. So there's your demand for metals, but not demand for fossil fuels.
Mike, thanks for your time.
Thanks for having me.
He's Mike McGlone. He is macro strategist at Bloomberg. My name's Michael McCrae with Kitco Mining here at Mines and Money Miami.
Kitco Mining special coverage of the Mines and Money Miami is brought to you by Snowline Gold.